All right, good morning, everyone, and Happy New Year.
Happy New Year.
Oh, that was a little bit late.
Still great.
Okay, welcome to the Teachers Retirement System Investment Meeting for January 3rd, 2019. Mr. McTeague, would you please call the roll?
Mr. Abbott.
I am here.
Thomas Brown.
Present.
David Kazansky.
Present.
Lindsay Oates. Deborah Penny.
Here.
John Dorset.
Present.
We have a call.
Thank you, Thad.
Supposed to say present.
So with that, excuse me, and I apologize, I do have a cold, and I will try to keep my hacking to a minimum. Please bear with me. I will turn it over to Rokitan to give us the Happy New Year news.
We'll start with what was a happier part of late last year, which was the November performance, and then we'll stop. And then we'll stop. We'll roll into how we ended the year, and my colleague David Morton, who's a partner of Rokitan, who's here with us today, will take us through our outlook looking forward for 2019. So maybe with that we'll start with, again, which was maybe the only bright point during a pretty volatile fourth quarter for markets in 2018. So you might recall in the US, equity markets as a whole were up about 2%. What drove markets in the US during that time period? It was actually value stocks that did quite well, which we haven't seen for a little while. Value stocks as a whole in the Russell 3 were up about 3%. That helped performance in absolute terms, and we saw actually some strong results from the active managers within the program during November. Again, still trying to make up some of the earlier underperformance for 2018, but that was certainly a bright point in November. Emerging markets were also up about 3% during November, outpacing developed non-US markets, which were roughly flat during the time period. And all told, for November, the Diversified Equity Fund was up about 1.7%. That brought the calendar year-to-date return to just over 1%, and that compared to the hybrid benchmark, which for the month was up about 1.6%, and year-to-date up about 1.3%. As I mentioned earlier, active management in the U.S. All told was up about 3%. That helped with relative results. And then some slight relative outperformance by the International Equity Composite, which, as I mentioned, did have a modest positive return for the month. In terms of performance for the other passport funds, the balanced fund for the month was up about 70 basis points. Year to date, that fund was down about 70 basis points through November. The International Equity Fund, which, as you'll recall, the structure mimics that of the International Equity Composite. In the Diversified Equity Fund, that was up again about 33 basis points. Year to date, that fund through November was down about 9%. What was driving returns during the year to date time period in the non-US markets was a pretty negative year to date time period for emerging markets as a whole, down a little over 13%, and developed markets down about 9%. The Inflation Protection Fund, that was flat for the month. The year-to-date return there was modestly negative by about 30 basis points. And the Socially Responsive Fund was up about 3.4%, outpacing the S&P 500 during November. So I'll pause there before we change gears and look at December.
Any questions about November? Great.
So, December, as you're all aware, global equity markets sold off quite a bit, by a little bit more than 7%. It was actually the worst December in more than 50 years.
Wow.
And in addition to what we saw with respect to equity markets, we saw the opposite with fixed income markets, with yields having come down quite a bit on U.S. Treasuries. Oil prices took a sharp decline as the weakening global outlook ensued in December. Equity markets actually fared quite well relative to the rest of the world. Emerging equity markets rather. They were down about 3% during the month. The U.S. was down about 9.3%. So if you don't mind, we handed out a December report. You can see there the very first number at the top left, the Russell 3000 down about 9.3%. The international composite benchmark, again, a mix of developed and emerging markets, that was down about 4.5%. Developed markets as a whole, developed non-US, were down about 4.8%, and emerging equity markets for the custom benchmark here, actually because it didn't include some of the markets that were down more, the custom benchmark was down by about 1% during December. The defensive composite did provide some downside protection. You can see that was down about 5.8%, and all told, the diversified equity funds hybrid benchmark was down about 8% during December. So what did that mean really for calendar year to date? You can see all told, the U.S. equity market last year was down about 5.25%. Developed non-U.S. equity markets were down about 13%. The emerging markets, based on the custom benchmark there, down about 14% last year. So again, some pretty notable numbers there. With respect to the balanced fund, last year that fund finished down about 1.8%. The inflation protection fund's underlying strategy, that fund was down about 4% last year, compared to, this is a preliminary tick on CPI, but CPI was about 2.25% last year. And then the underlying strategy for the socially responsive equity fund last year was down about 5.5%. So again, we'll talk a little bit more about the outlook going forward, but any questions on how we finished last year?
Questions on December to remember?
One thing maybe it is worth mentioning, we've talked about the defensive strategies within the diversified equity fund. I mentioned in November we saw value was something that did help in the portfolio. December was a similar month in that regard. We actually saw value do a little bit better relative to growth, which we hadn't seen for quite some time, and we also saw low beta and low vol stocks do quite well for most of December. So on a relative basis, that should have served performance from active management perspective quite well.
Yeah, I just want to say, I've been a skeptic about the defensive strategies, and at least on a benchmark basis, it's really for last year, you're looking at almost 375 basis points of better performance from this defensive strategies benchmark than the hybrid. We'll see, we'll see how it turns out when we get a look at the numbers, but that's terrific. So
It's there for.
what's that?
That's what it's there for.
That's what it's there for, and when we entered this fourth quarter of volatility, it seems to have, at least on a hybrid, on a benchmark basis, performed as expected. So that's great.
So maybe if there's no other questions or comments there, we'll change gears and look forward.
And I'm just going to make a couple of comments. First, the slides that we distributed are materials that we send to you on a regular basis. So you'll have seen these. Seen this information, maybe not in this exact format, but you'll have seen this information. And we invited David Morton here today, and he's attended quite a few other board meetings, because David is our chief market strategist. So what that means is he part of his role is to pull together the information that we gather through our asset allocation research, our equity manager research, our fixed income manager research, our private market research, and the work he does with his team to help us think through, along in collaboration with our clients, how portfolios should be structured given client-specific objectives and risk tolerance. And we go through, as you know, a pretty quantitative exercise using all sorts of assumptions. But David has a key role in helping us develop those assumptions, and then helping us provide a qualitative overlay onto the quantitative results of our modeling exercises when we work with clients on asset allocation. We had invited Mike Haddad here because he also spends a lot of time thinking about markets and the outlook for markets and expected risks in the marketplace, but unfortunately he wasn't available. But John's going to fill in right? And I'm sure this is the kind of conversation that I know the board has said they'd like to have on a regular basis. And so David is here today because it's the first meeting of the calendar year, but we're happy to have this discussion as the year unfolds, and to the extent there are issues or opportunities that we want to incorporate in our thinking about the pension funds asset allocation, it would be part of those discussions.
Thank you, Rob.
The floor is yours.
Good morning, Happy New Year to everyone. I believe I was here almost exactly a year ago to talk to you about markets at that point in time.
How'd you do?
You know, I think sort of the notion that I'm going to tell you what's going to happen in 2019 is a little far-fetched. So, you know, I think we try and sort of take disparate strands of information and blend them together to try and understand where we are, and then think about sort of ranges of outcomes for the future. To expect that we actually know anything about the future would be nice, but anyway, with that as a setup, and I know it was sort of Mike introduced this as I'm going to talk about the outlook. We certainly, on an annual basis, create this document that you have in front of you. I'm not actually going to refer to it much. I'm going to talk about some of the themes in it. We create this document with the idea that if you look at it 12 months out from here in December of 2019, there's still some things in it that are relevant, which is quite a daunting task to actually put something down in print that clients are going to be able to open months and months in the future, and still there'll be some relevance to the comments that are in there. With that said, how did we get here? You certainly heard, you know, where we are in terms of sort of the quantitative data, how you've done different points in the year. When I was here a year ago, the markets were on a tear. If you remember, January of 2018 was a great month, one of the best Januaries we've seen for a long period of time, and then literally the second day of February it all ended.
Right.
It all ended with a CPI report that seemed to spook the market, and we certainly had the backdrop of sort of trade. It was a trade spat back then. Now it seems to be a trade war of varying degrees. Was in the background. It didn't seem to be actually driving markets at the time, but there was a worry that inflation was going to pick up faster than people expected, and that was what initially spooked the market out of its bull phase in the January of 2018. We sort of recovered from that after a few months' time. We had a great later spring, summer period through the third quarter, and you've obviously heard how the fourth quarter did. And it wasn't such a good period of time, obviously, and we ended the year with negative territory for all of the equity markets, positive territory for very high quality bonds, negative territory for anything that had spread product in the fixed income market. So to me, there's two really important issues, and there's a whole host of issues that we could discuss that I think are somewhat sideshows. So I'm not going to talk about things like Brexit or Italian politics or any of that, because whilst important, those are all sort of sideshows. I think the two really big issues are the trade war and relationship with China that the US has today, and also this sort of sort of growing war or tension between Federal Reserve policy and economic growth in the US. So I'll start with the trade war. I don't know how it's going to unfold from here. I don't know why we started it. I won't say any more about sort of the politics or anything to that extent of why we started it. But it seems there's sort of, I think a year ago I made a Game of Thrones joke or image to sort of talk about sort of the election that we've just gone through. What comes to mind when thinking about the trade war and its impact on markets is shooting yourself in the foot. It just seems like there was no need for us to approach sort of international trade relationships in the way that we did. It's ongoing. We're not sure how it's going to unfold. It feels like a giant game of chicken with the global economy and markets in the middle, taking sort of the pressure and tension of the whole thing. And there's a certain political calculus on our side and a political calculus certainly on the Chinese side. And I'm going to ignore sort of trade issues with Canada, Mexico, the European Union, because I think they're absolutely secondary to sort of the primary issue, which is the U.S. versus China. We keep talking. There's a lot of false narrative about what actually is going on. We say a level playing field, fine, but we've never had a level playing field. We've just had generally improving sort of trade relationships and tariff levels between us and various parts of the world, China included. So to say, well, it's not a level playing field, is sort of not actually the point. It never has been. But that aside, why is the U.S. doing this? I'm not going to necessarily explain why we're doing it in the way that we're doing it, but maybe part of the calculus from the U.S. side is that as a portion of our growth and our economy, and therefore ultimately the impact on our markets, trade isn't as big a deal as it is for China. China trade is a massive deal. It's a real growth and driver, certainly looking backwards, of economic growth in China. That might be lessening as time goes on as they build a domestic market, but it's still a big deal for them, a much bigger portion of the Chinese economy than it is of the US economy. It's also a bigger deal for the European Union than it is for the US. So I think if you're in the US and you want to take an aggressive stance, you can say, if we have any kind of trade tension and it impact the economy or markets, it's going to impact them much more than it's going to impact us. Therefore, we hold the stronger bargaining, we hold the stronger hand. They have to come to the table and give us something. Well, that makes a certain level of sense if you're willing to put the economy and markets into sort of this kind of pressure, which doesn't seem necessary. What I think it ignores is that we have an election calendar here and they don't. So for China, President Xi is president for life. His election calendar is already done. Whereas we obviously know what our election calendar is. So we don't have sort of equivalent sort of electoral pressures in that sense. What the Chinese are very worried about is their level of economic growth, and their level of economic growth is slowing more than anybody expected. So I think that is what I think markets started to have sort of understood with to an increasing degree as the year went on in 2018, and certainly understood more so in December of last year. That has a big negative impact, obviously, on China. It has a big negative impact on emerging markets in general. It has a big negative impact on the European Union. And so, we have, those issues sort of, holding back markets as we speak today. So if we wake up and Trump has called President Xi and they actually have a framework of how they're going to fix this, not have a deal, that's like months and months out in the future. But if they had an actual agreement where they were going to work on it, that would probably be a major positive for markets and a big plus for both our economy, theirs, and so on. And I think would be the starting point for changing sort of the trajectory of markets. For the longer that doesn't happen, I think the more pressure that we're going to feel in markets, because at the same time, and I'm going to segue to sort of Federal Reserve policy here, at the same time, what I think surprises about 2018 is the stock market for most of the year was saying things are great, and the bond market was saying, no, they're not. And we get this at times in inflection points in the economy where the bond market might sort of be skeptical of where we're going, and the stock market still says, no, we're still partying. It's great. We're still going up. And then sometime in the fourth quarter, there was, they started to sort of notice, maybe we're not in sync. And then the Fed, Jerome Powell in December said, I think as he said, which I would have to say, I think we at Roboton have been sort of expecting that we weren't going to get the 4 interest rate increases, the one in December and then 3 more in 2019, like everybody was expecting, because that would have pushed the yield curve into a very significant negative slope, and that it just doesn't jive with where we were in the economy. So here we are, sort of only a few weeks further on, and now we're expecting that the Fed is only going to increase maybe once, maybe a couple of times in 2019. Excuse me. I also have a cold, and so
Who doesn't? That's what I want to know.
the yield curve shifted significantly. So ignore for a second what the Fed does and says. The bond market actually gives you active information on a daily, minute-by-minute basis, and the rest of the yield curve has said for the last couple of months here, maybe 4 to 6 weeks, that the economy is slowing, the Fed's going to be slower, and that when we get to the end of this year, we'll be much closer to recession. We might not be in recession, but we're going to get much closer to it, and those are things that we need to be concerned about. What the bond markets also say, maybe taking a cue here from the oil market, is that CPI, inflation, is going to be a lot slower in 2019 than perhaps we were expecting a few months ago. Excuse me. So what does all that mean? So, like I said, as far as the trade war goes, we could end that in moments. Oh, thank you. Appreciate that. We could end that in moments, or it could be going on at the end of this year. It's really unknowable at this 10 seconds. You know, if you ask me what do I worry about, I worry about that there's no grown-ups left in the White House. It's, you know, and it sounds like a joke, but this time last year it was a joke. This year it's not a joke anymore. It really is a concern that you know, people leading foreign policy are not too strong at this point. It doesn't seem like there's anybody that's in the White House that's going to say you shouldn't do it that way. That would be a mistake. Those people seem to have all left at this 10 seconds. So why would we get a quick end to the trade war? We'd only get a quick end to the trade war if Trump was really under pressure, I think, this moment, or if he wants to really put an injection back into the economy so that the election period, not this year, but next year, is stronger for the Republicans. So the question then is, when do you need to end the trade war or signal the end of the trade war so that there's enough ramp time for the election cycle to benefit from the economy strengthening? And I would suggest to you that can't be that far out. So the most positive feeling I have is that you know, if you're focused on the political cycle, you probably need to do something in 2019, and probably earlier in 2019 rather than later. That's as positive as I can get on that score. On the interest rate front, now I think we're sort of at a really interesting point. You know, I think the Fed's under all kinds of pressure. We've obviously heard Trump make statements and at least go through sort of some internal process to ask, do I have the authority to remove Jerome Powell from his position? I would say that the Fed is mostly independent, but that we'd be foolish to assume that any Fed that we've ever had has been immune to political pressure. They go talk to Congress on a regular basis. They're going to turn up to Congress at every whatever period of time that they go every month and be, you know, and face a lot of hostility from lawmakers and not be influenced by that. It's hard to imagine. Their job is to keep inflation low, to keep the economy humming along. They have a dual mandate. So we should expect that, you know, that they're focused on that. Going forward, excuse me, 2019, what should we expect the Fed to do? if inflation CPI as is measured and is going to be released over the next few months will actually tick lower, and you'll probably get your commentators on CNBC or whatever financial news network you say, why is inflation falling so low? Well, it's pretty easy. The oil prices fell a lot, gas prices fell a lot. It's sucking the headline number of CPI down and will do for the next few months. You should expect to see that. It's already somewhat low, but it's going to get pulled lower. Not all the way below 1% probably, but it's going to look kind of weak for a few months here. That's going to encourage the pundits to talk about recession more than they were doing a few months ago. When at the same time, the economy is actually fine. We grew at 4% in the middle of the year. The Federal Reserve's job was to slow that. They've been intending to slow that. That's why they've been pushing up short-term interest rates. So what surprised us for the most of 2018 was the Fed was trying to slow the economy from its 4% pace. It always succeeds. There hasn't been a time in economic history where you put up short-term rates and it doesn't slow the economy. It's obvious that it's going to slow the economy, but the stock market was saying 4% growth. This is great. Earnings are good. Things are great. So it was clear to us there was a tension growing between the way the bond and stock market saw things, and now we sort of see this tension sort of play out. What happens going forward? It's hard for us to see interest rates rising significantly from here. So what does that mean? It means interest rates could be 3%. I'm talking about the 10-year Treasury right now. Interest rates could be 3%. It could be 3.25%. I don't think that it can be 3.5% to 4%. Why do I think that? One, inflation's not going to be high enough to suggest that they should be all the way up there. U.S. rates are already higher than anywhere else in the developed world by a long way. Long way. Excuse me. So there's no reason why U.S. interest rates should be materially higher, just based on those couple of statements. But also, if they were higher, I think this is what you've got to understand about today's markets, which, I want to be very careful in saying this is different, because I know that that's a big failing statement and should stay away from that. But I think what people miss about sort of the bond market, inflation, and the way things work in today's world is that the amount of debt that we have today versus 10 years ago, pre-credit crisis, is far higher. The entire global economy is way more sensitive to interest rates today than it's ever been. So what that means is when you see a 25, 50, 75 basis point rise in interest rates in the US, but certainly anywhere else in the world, that's pushing up borrowing costs, it's suppressing growth. And so you keep sort of bond yields in a range, and that's what we've seen now for the entire time we've been rolling out. So 16 years. For 16 years, we've sat in front of clients and said, interest rates probably won't rise much, and I think we've had lots of clients year by year by year come to meetings like this and assume that interest rates were going to rise in that particular year, and they haven't for the most part. They've generally fallen. Where we are today, 264 I think this morning on the 10-year, I don't see interest rates necessarily falling much from here, but I wouldn't see them north of 3.25, which I think is roughly where we got to on the 10-year Treasury rate. The economy is not going to be strong enough in 2019. It's going to continue to weaken with or without the trade war. And so I think we're sort of stuck in that sort of trading zone. Again, back to the stock market. It really, I think, depends upon what happens with the trade war. It can all be made to go away in very quick order. Maybe it will. It's, I think when they went to Buenos Aires a few weeks ago, and there was the tweets that came out as a result of that meeting, that's probably how we're going to find out that the trade war might be over, through Twitter. But I think you also want to see sort of a similar statement from the Chinese to signal that it's over. Without that, I think what we don't know going forward is how much slower can the Chinese economy grow. So of the things that we should be worried about, Chinese growth is one that we should be really concerned about going forward from here, because that has a big impact on a whole range of different markets around the world, certainly emerging markets. I didn't talk about all the things going on in Europe. I think Brexit is a hard Brexit, as you've heard about in the press, is a really low probability. The press doesn't say so, the politicians don't say so. You just got to imagine that British politicians at both sides of the equation have weak hands, and so they bluff all day long. So the only thing they've got to bluff with is hard Brexit. There really isn't anything else. So it become a little bit of a sideshow. They'll figure out a deal to fudge something in the future. As still a British citizen, dual citizenship, I hope that they have a second referendum, because why would you want your child or grandchild to go from having a passport that's eligible in 28 countries to a passport that's eligible in just one? It doesn't, and that's without talking about anything else. So that's sort of,
we should make all of our children EU citizens.
Yeah.
That would be
yeah, well, I know we've made bad political decisions here in the last few years as well, so I'll be careful if I say the worst political decision in generations, but it's it deserves to be in that part of the conversation. But it's, there's a risk there. There's a risk of Italian politics being messy and sort of impacting the periphery there. I think there are relative sideshows, and I don't think they're going to drive markets. I think it's really the U.S. versus China that drives markets, and it's the Fed versus the economy that drives markets as well. The positive aspect of market prices falling at the end of the year has made some asset classes quite interesting in terms of investing going forward. So for many years, this time last year, we would have said there's no markets that are cheap. We said there's a lack of opportunity anywhere in the world. Today we have credit markets that have repriced. They're not all screaming buys, but they're all much more interesting than they were a year ago, and suggest more attractive returns looking forward from here.
Can you just interrupt, when you say credit markets, just what do you
So anything below investment grade, anything with credit risk, sold off either all year long or progressively as the year wound to a close, and aggressively in December. So something like high yield bank loans had a really bad December just alongside the equity market. So the bank loan market, for example, has an average price of 93 on it today. It doesn't mean that it's a screaming buy, it just means that you've got a floating rate coupon, which is attractive today in today's world. LIBOR is almost 3%. You've got an attractive coupon of 5.5–6%, and a discount of an additional 7% off a market where we expect volatility going forward, and we expect credit risk, but we also expect that we would get paid reasonably well for taking that risk. Excuse me. High yield also sold off. High yield has more challenges to it, but it is cheaper today than it was a year ago. There's other markets in the credit world which are more interesting, that something like your OFI program could take advantage of. We've also seen, I would say, not only prices fall towards the end of the year, but liquidity fall at the end of the year. And something like the OFI program is designed to take advantage and to provide liquidity to credit markets when we get into a period like late December, when the deals are hung with a variety of different types of asset and situation that they don't want to keep on their balance sheet. They're willing to part ways with that to patient capital, liquidity providers, and like your OFI program, at a discount, basically. So we would hope when the dust settles and we start to get reports of what happened in December, that the OFI program has been a big beneficiary of the fall in liquidity in December. Excuse me, sorry. I'll end there, but talk about any questions.
Questions for David?
So I've got a question about the Fed and the interest rates. So prior to like the global financial crisis, the 10-year Treasury rate was much higher. It was like 3 or 4.
Yeah.
And so I understand that, you know, when the crisis hit, that in order to put more, you know, credit out there to folks, we brought the interest rates down. So do you ever see it getting back up into the 3s and 4s? Would it make sense to bring it back to where it was? Or are we in a different universe now where, you know, high 3s or even low 4s are just not possible?
So I think it's a really good question. It's one that we struggle with all the time, because, you know, if you ignore what's actually happened in the last 15 years, for example, and actually even go back before the credit crisis, and just think about what components of the economy have been important in figuring out what the right level of interest rates should be, the only conclusions you can come to are that rates should be quite a bit higher than they are today. Under normal situation, the 10-year Treasury has actually tracked nominal GDP very closely. So nominal GDP is whatever GDP is. So maybe we're running around about 3% today, plus inflation. Let's call it 2, just for argument's sake. It suggests a 5% 10-year Treasury rate, and through time, that's been a pretty good guesstimate of where the 10-year Treasury should be. And today we're at 264 this morning. So, you know, one, and I know you're all teachers, and sort of, you know, sit in front of a classroom and say, you know, I've told you this 5 times. Why don't you understand? Why do I have to tell you a 6th time? Well, you know, we have sort of the same sort of feeling when we talk about interest rate outlooks with clients, because for, you know, for
My whole career.
whatever, for your whole career, for a long time now, every year we have meetings like this, or any meeting with a client, and the expectation is that interest rates are going higher. Every meeting, almost without fail. And I think one of the things that we've tried to do in meetings like this is say, yeah, we understand that rates look like they should be higher, but for all of this period of time, they've confounded what we would have expected. So you should learn something from that there's something else going on that we can't quite explain. We can rationalize, but we can't quite explain. So the rationalization, as I suggested, is there's massive amounts of global debt, way more than there was pre-credit crisis. And you know, the credit crisis explained there's too much debt. Well, today we have a lot more. So how is it the economy is functioning nice and fine, yet we've got way more debt? What does that all mean? And, you know, I don't know that it's an explanation, but it's a rationalization that if rates actually rose to the 5% as suggested by, you know, the nominal GDP that I just talked about, it would strangle the global economy to a standstill. So who could pay much higher interest costs? Businesses couldn't. They've been enjoying borrowing at next to nothing for a long period of time. There's many businesses that could borrow at much higher interest rates and still function fine, like your Apples of the world, but, you know, most of the below investment grade world couldn't withstand, you know, 1% or 2 higher in interest rates. So I agree. It's always looked like rates should be higher, but it hasn't happened. So there's some other explanation. The other things I would point out is we still have quantitative easing in parts of the world. The Japanese are still putting liquidity into markets. The European ECB is still putting liquidity into markets. There's still trillions of debt that has a negative yield on it. Imagine that. I mean, years ago, Robin and I had a smart young guy that worked for us, and he and I sat around and we said, could interest rates be negative? And it was just a thought experiment. We didn't think we came up with the answer that they could, but we didn't actually think it would happen. And then not only did it happen, but trillions of global debt now have a negative interest rate to them. So think about that. If you're in Germany and you're an insurance company that has to make a spread from fixed income markets to be able to function as an ongoing insurance company, you have to find somewhere in the world that you can earn that spread. You can't invest in your own securities. In Germany, you've got to export capital. There's many regions of the world that have to export capital. To them, our interest rates don't look low, they look high. They're German 10 years around, I think is around about zero, maybe it's still slightly negative, ours at 264. It's a big spread. Now you pay for that through hedging in the currency today, but you still are able to pick up sort of significant yield from being able to do that. Japanese, big exporters of capital and have been for more than a generation because there's very low returns from their fixed income assets. So all of that capital from those regions needs to find somewhere to get invested, and I don't see that changing. This still is a safe harbor, if you like, in global financial markets for being able to invest a lot of money. If you have think about the size of the Chinese reserves, for just as one additional example. If you have $100 billion to invest in a quarter, because that's just what you've accumulated reserves at, where else are you going to go? There isn't anywhere else to go. There's nowhere else to go other than sticking that money under the proverbial mattress. If you want to invest in something that will pay you a return and give you your money back in a few months' time, you have to come to the US for that kind of size. So I think that we're the beneficiary of global flows. I think that we're beneficiary of quantitative easing. I think that we're the beneficiary of this massive amount of global debt that we've got. So we should at some point get back to higher rates. I don't see the path today.
So I have a question. I read an article this morning about, or glanced at an article, to be clear, that mortgage applications were down approximately 10% in 2018.
Yeah.
We have a debt-ridden recent college graduate, I'll call it, or folks that have graduated in the last 10 years that are saddled with debt from educational loans. Does that come to a head if we're entering a period where people can't sell a house, or if there's less applications? I presume there's less turnover of housing. Does this kind of repeat into what happened in 2008? But now you have the added component of the educational debt kind of saddled on top of that.
Yeah.
That was kind of in the periphery in 08, and it was really more about mortgage, a lot about other things. But do we see that hit a head this year?
So I think there's two questions really. So the last page of your of the presentation that we handed out talks about the housing market. And I think the housing market's really interesting. I think it's where I get most excited is where there's a common perception in the marketplace fueled by the press about a particular theme, which is totally misses the actual fundamentals. And therefore we can sort of bring together sort of what we think we know with what's out there in the press and say, no, actually things are different. You should have a different expectation of this. And I think the housing market is a great example. So I agree that the press has been setting this up for a long period of time. House prices have been rising for years now, therefore we must have a bust. Because in our recent memory, we had the biggest real estate bust that the residential market had ever had in real terms. So it's sort of front and center. It's the last war, if you like, as far as housing is concerned. But just think about that statement again. This isn't my statement. This was from Nobel Prize winner Bob Shiller, who said the last housing bust was the biggest housing bust in real terms that we've ever had in economic history. I take from that it doesn't happen that often. Right? It should be anomalous. It takes generations to set up for something that bad. So it shouldn't happen again. Now that doesn't mean it won't, but it shouldn't happen again. So why should we feel like it shouldn't happen again? Well, first of all, to the interest rates are higher, were higher a few months ago. Hit mortgage rates, and that's going to abate here. So it's going to be more affordable. So you'll actually in the next month or two start to see articles that talk about mortgage rates are higher, people are more interested in buying, and we should have a great spring in house buying sort of period of time. It's totally reasonable to expect that with rates rising, that we slow mortgage, as it did in 2018, that we slow mortgage activity. The part about the student debt has changed the complexion of what home young people live in. They can't buy a home. They don't have the down payment anymore. They have the monthly check. They don't have the down payment anymore because of all that debt. So they rent. So I don't know where you live, but I'm sure that there's a building going up close to you that is going to be for rental. Everywhere. I live in Westchester. Just about every postage stamp space of free land has had a new apartment building built on it. So there's a changing sort of complexion of what homes individuals live in. Back to home prices. We see sort of home prices, and this isn't a quarter by quarter statement. This is sort of for many years to come. Slow, gradual stability to a general rise in prices over many, many years from here. Why do we say that? One of the impacts of the credit crisis was that it decimated home building. It destroyed all the home builders. Their capital structures were gone. They lost a lot of money on land and so on and so forth. We have built far fewer houses in the last decade than we built, even if you don't take the period of time right before the credit crisis, go back another 10 years and then take the 10-year average of the number of homes that we built from, say, 1990 to 2000. And we're still building far fewer houses today than we did during that period of time. And our population is 30 million larger than it was at that point in time. So we're not building, and this is not just homes for sale, this is also for rental homes. We're not building anything like the number of homes that we've built historically. So as the population grows, as employment continues to inch up, we should see stability. We'll see sort of, quarter by quarter mortgage rates are up versus down, easy to get a mortgage, hard to get a mortgage. You're going to see some sort of changes in the pace of activity. You're going to see still some headlines in the next few months about home builders threading about sort of, inventory and where they are. But we should see sort of general stability and improvements over years to come from here, in our view. With the one exception that if we do have a significant recession, then things should change. But without that, I think that we should have stability.
Can I ask a question about China? So, historically, we have not just historically, we have not invested in Chinese equity. And we are considering potentially a policy change. It sounds like you're saying that not a bad time to go into China because pricing has dropped and Chinese equities priced more attractively. On the other hand, absent a resolution to the trade war, prospects for the Chinese economy are questionable. So, what would your advice to the board be about going to China at this point?
I think you should be looking to invest in China, certainly. I think there's lots of pitfalls, lots of challenges, but China is only going to become a larger portion of the global equity market. So I think one of the internal conversations we have at Rokuton today is, it's a larger portion of an emerging market equity portfolio today and will only grow significantly. So we're asking ourselves the question, we haven't come to an answer yet, but we can see at some point in the next few years where we have dedicated China equity allocations, that we take it outside, well, maybe not take it outside, but add on to an emerging market equity allocation, a dedicated China allocation, because you can't get enough China from just having an emerging market portfolio. If you look across the globe and look at sort of what's really sort of moved the U.S. market in the last decade, sort of the technological sphere, there's a couple of places elsewhere in the world that have strong components of technology and innovation driving their equity markets, places like Israel, for example, or India, or China. So most of the rest of the world has old industry exposure when you invest in the equity market. There's only a relatively narrow set of places globally where you can invest and have access to innovation. So if having access to innovation is important going forward, there's a further reason I think that you should consider Chinese equity exposure. And it's large economy. Its equity market is only going to grow in market cap, and I think that it's going to have lots of trials and tribulations, just in the way that our own equity market economic history has in the last couple of hundred years. It's not going to be a straight line. It's going to go up and down and have a lot of volatility, and access is not that easy, and there aren't that many products to be able to get direct access to it today. But I think it absolutely should be part of what you consider your long-term opportunities.
Thanks. Other questions? Yeah,
Do
Tom.
you have any thoughts about what's happening in Brazil with that Trumpian-like person down there taking over? Thoughts about that? How it might affect anything?
So I'm a little colored because I watched a Michael Moore documentary the other night. So I'm more negative than I would normally be on this type of thing. I thought it was interesting. I watched PBS Evening News last night, and their section on the swearing in. I guess that Bolsonaro had various foreign leaders coming to share the day with him, and it was a who's who of who you wouldn't want to hang out with. let's just put it that way. So
Scary.
yeah, I think the rise of populism generally is disturbing across the globe. What I think is a little more complicated about Brazil is from a political standpoint and sort of views and the way he handles himself, there's a lot of things to be concerned about with Bolsonaro. What sort of mitigates that a little bit is how seemingly excited a large, not an immaterial portion of the Brazilian population is for somebody like that. And it's easy to make a parallel with how it feels like the same group that likes Trump, likes Bolsonaro in Brazil, but I think it cuts way across that. I think Brazilian politics has been an ugly place for a long period of time. The population feels let down by all sides, and I think they're looking for somebody who can deliver better times for them and create sort of some change. It's alarming that they have to choose somebody like that to try and deliver that, though. But Brazilian equity market. So if we had a chart up on the page of all the equity market performance from 2018, it's a sea of red with one green line, and that's Brazil. That was Brazil based on their reaction to Bolsonaro. Also, the fact that they've had a recession and market crashes for a period of time looking backwards, but in large part because of Bolsonaro as well. So I have mixed feelings on that.
Okay. Anything else for Dave?
But I just add
Yeah.
one. So there's again, Michael Moore, don't feel that positive about lots of things. The truly, there's a couple of really big humanitarian crises going on in the world. One is Yemen. The other one that doesn't get anywhere near as much playtime is Venezuela. So Bolsonaro, with all of the negative things about him, if he was able to actually get Latin America and maybe with the U.S. help to do something positive for the people of Venezuela, that would be it's one thing to look forward to that might be a positive in Latin America.
I had one quick question on the trade war with China. You said it's never been a level playing field, and I agree. But has has the trend been positive towards a more level playing field, or the trend been negative? It's been a positive
Yeah, it's
trend.
been moving glacially in the right direction.
Yeah. Okay. I just wanted to know what the facts
If you go
were.
back 30, 40 years, we didn't trade with China.
Yeah.
So there was no trade. So
Yeah.
going from, so obviously, there's no play.
Yeah, I mean, so the trend's been positive, the tariffs have been less,
We
yeah,
have no tariffs because we wanted them to sell us cheap things.
Yeah.
They said, we want to sell you cheap things, we don't want to let your stuff in or else you'll crush, we won't ever be able to get started. And so gradually they're sort of moving in the right direction, but we came in and we said, no, they have
but
to
it
be
to
here.
be, yeah, that's what I thought.
You know, so it's been moving in the right direction. So this is what the false narrative is.
Yeah.
You know, because it's not a level playing field, that they're just cheating us. Well, they're not. We agreed that we wanted to trade with them on these terms. There's no trade agreement in place today that wasn't mutually agreed upon between both parties, right? So
Yeah.
these are the trade deals that we negotiated, that we were happy with, and that over time we've managed to improve. Yet, you know, the narrative is that we're
Yeah, I just wanted to, yeah.
we're being taken advantage of in many, many different ways, which is just not the case.
Reestablish facts, okay, thank you.
Anything else for David?
I just want to say, on behalf of the other people that wear gray suits and purple ties, great luck. Thank you for your being a trendsetter.
How about the socks, the socks?
You know,
Mike as well.
It's required at Mercantile. You know, so I find these kinds of comments really helpful in putting, you know, the myriad of facts and data that we see all the time into some sort of framework for thinking about the world and the global capital market. And I think it's also very relevant for how we think about the asset allocation of, particularly of the pension fund, because the variable funds don't use as many asset classes. And so one of the questions, and I'm sorry that it was scheduled at a time when Mike couldn't join us, because I know he's thinking about the very same issues. But I think one of the questions that this begs is, okay, what should the duration of the bond portfolio and the pension fund be? And this is, you know, we're above market but below target, and that's been a very deliberate policy. And so I think we should be talking about that. We have been talking about it. It's certainly not been an issue we nor the Bureau of Asset Management has ignored in any way, shape, or form. But it should be something that we should continue talking about and maybe reconsider where we are on the implementation pace for long bonds. And I think David brought up some points about credit markets and taking a fresh look at OFI, which I know we are doing, and I think that's an opportunity. In terms of our investments in global equity markets, I'm not sure, unless we rethink the weighting to those markets, I'm not sure that there's much to do. We basically have largely a beta exposure to global capital markets, with global equity markets, with an emphasis on the US. And I don't think that, and you'll correct me if I'm wrong, I don't think that anything David had said would lead us to reconsider that at this point. So I think it's really a focus on what should we be doing in fixed income markets, if anything different.
Including the risk fixed income, like the high yield, you know, which is
Yes,
an
absolutely.
issue that's kind of interesting. There was this uptick at the end of the fourth quarter in the spreads, and does that is that a trend that we expect to continue, or do we think it's a blip? I don't know. It sounds like you think there's some interesting things going on in high yield, but there's other credit markets that are, I think, in your nomenclature, more interesting, like in the OFI space.
So in terms of the question about is it going to continue or not, you know, exactly 3 years ago we had a period like this in early 2016 where credit really sort of froze up. In the first week of December, it looked like Deutsche Bank was going to fail or not pay on its most junior debt securities. In a few weeks' time, that turned out not to be the case, and you know, we had a big rally from then on in credit, and everybody forgot about sort of the volatility that we've had. So this feels like it should be more like that. Partly because the economy is still strong, even though interest rates are up, credit spreads are up, interest costs for highly leveraged companies are higher. It doesn't feel like the economy is going to go off a cliff. It feels like it should slow. It doesn't feel like we should have sort of a major recession and a major credit recession as a result of that. So, the vulnerability of high yield generally is though that it's the most sensitive piece to sort of the capital structures of the specific companies. It's more junior in their capital structure, junior to something like bank loans. So you worry a little bit about, well, if the economic trajectory I just outlined, if things turn out worse, then it'll be worse for something like high yield. In something like bank loans, where you're senior in capital structure of those same and floating rate in those companies, and LIBOR has been only rising. The floating rate reference rate has only been rising throughout all of 2019. So that's sort of another tailwind at the back of bank loans. Bank loans, if you can buy in sort of the low 90s like you can today into that market, offer some pretty decent value from our perspective. Some other parts of the credit market, such as emerging market, fixed income, or capital securities issued by banks, you can buy. I don't know which bank to say. Which is the favorite bank of the teacher trustees rather than the least favorite U.S. bank. But the major banks in the U.S., if you look at their junior level of capital securities today, are paying 6.5–7%. If you look at the preferred market, 6.5–7% of a J.P. Morgan. Again, I'm not sure if they're your favorite or least favorite, but that to me is a level of compensation for a fixed income investor, even that far down in the capital structure, that shouldn't actually exist in today's world. I mean, it's a rock solid bank. I mean, outside of the U.S. HSBC, you can get 8–9% HSBC. I mean, it's a very conservatively run, very stable bank. So, there's little pockets of sort of opportunity that have grown over the last few months here that we find quite interesting in the credit space.
But would be hard to take advantage of in our asset allocation because they do tend to be these niches. So it would have to be through a manager's mandate, which has flexibility, which is OFI. Anything else for David? Thank you.
Thank you,
Thank you
David.
for soldiering on.
Yeah. Yeah, Theraflu.
Yeah. So we wanted, John, if it's okay to move on to the next topic?
Yes, please.
So we wanted to take a very few minutes to talk about the investment policy statement. And I say a very few minutes because two key members of the working group, Susanna and Valerie, are not able to join us today. So the decision to include this in today's agenda is really to call the board's attention to the work that's been done thus far in restructuring the investment policy statement for the qualified pension plan. So there's another investment policy statement for the variable funds. That will also have to be updated. This is, as you know, work that's been going on for many months. There's been a working group that has spent a lot of time drafting and redrafting this document. And what you have today in front of you is not the final document, but it is very close to final. And and we thought sufficiently close to final so that between today's meeting and February's meeting, we would encourage you to take a look at the language and the structure of this document. It's been significantly changed from the prior version, which you can see was adopted about 12 years ago in final form. We've updated it to reflect all the work that's gone on at the board level in terms of defining investment beliefs, in terms of defining asset allocation and other policies. We tried to make it more user-friendly, so it's been streamlined. We've added an executive summary. We've added the investment beliefs that the board adopted a month or two ago. And we extracted the policies to be exhibits, so that those are intended, the exhibits are intended to be the more dynamic elements of the IPS. The body of the IPS is intended really to describe policies and procedures that are unlikely to change in the near term. But for example, the asset allocation policy might change, other policies might change. Those have been included as exhibits. So our hope is that we can have a session in the February meeting that is focused on this document, in which we get some feedback from the board on the substance of the document and the overall structure.
So if I may, I just want to say, I know she's not here, but thank you to Diane Randall in the controls office, who has been helping to kind of
Enormously.
move all this around into a workable document. And as you can imagine, as I think Robin alluded to, a lot of people had a hand in crafting this, and I think people really looked at sections of this to try to make it as user-friendly as possible. It's a struggle that I was here when they did this, and so were you in 2006. And it's always been a very cumbersome document. I think this document, if I do say so myself, is much more user-friendly, not only for trustees and BAM staff, but I think just the general public that wonders what it is that we do and how we go about doing things. So I just wanted to say that the other thing, and I think Diane would want me to say this, is at the very end, we'll go back through the table of contents and make sure everything matches up. So any things like that. And we've gone through this down to even looking at different fonts to make sure it's more appealing to people as they go through it and won't hurt your eyes. So any comments and things like that, we're happy to take in email form if you have a particular font that you'd like us to
Just
incorporate.
no Comic Sans.
Yeah, that's it. Yes. Yeah. Well, make that note. But and I want to thank Robin for really keeping us on track and adding a lot of her. Unique ability to pull out things that she's just been around for through the years that she knows will come up, and on a personal level, I appreciate that. So thank you.
My pleasure. So, to be discussed further, we will continue the working group. We'll continue to spend some time on this, making sure. Really, I think the issue now is just making sure that everything flows in a way that makes sense to the reader, but it is very close to its final form, so I think it's appropriate to get feedback on it.
Any questions for Robin or other members of the working group at this time? Great. Robin.
And does that conclude the public session?
Great. If there's no other business on the public agenda, would entertain a motion to exit public session into executive session.
Yes. I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you, Ms. Penny. Is there a second?
Second.
Thank you, Mr. Kazansky. Any discussion? All in favor of the motion to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstention? Motion carries. Okay, we're back in public session. Susan, would you please report out of executive session?
Certainly. In executive session, a policy matter exception was discussed, consensus was reached, which will be announced at the appropriate time.
Thank you very much. I believe that concludes our business for today. Is there a motion to adjourn?
So moved.
Is there a second?
Second.
Thank you. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
It is unanimous. The meeting is adjourned.